everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 12 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled Money Management. You can read the original post at samfury.com.
Welcome back, everyone, for another deep dive. You know, I love to keep my investing pretty simple.
A lot of people think investing has to be super complicated, but this book really cuts through the noise and kind of gets to the core of what really matters.
One of the biggest takeaways for me was this whole idea, less is more.
He's super big on really concentrating your investments. Pick a few winners and really get to know them. Imagine trying to keep up with 20, 30, or even more different companies. You're never going to have a deep enough understanding of any of them to really make smart decisions.
And that's where the big wins come from.
When you can really anticipate how a company is going to perform.
Because you've been following them and you see what's going on in the markets.
You're not just reacting, you're ahead of the curve. You're thinking strategically.
Okay, so this kind of leads into another big thing that I found really interesting, which is he calls it the magic number game.
Oh, yeah.
Which is basically how many stocks he actually recommends owning.
Mm-hmm.
And the numbers were way lower than I thought they would be. What's the general idea there? How many are we talking?
If you have a smaller portfolio, say $5,000 to $20,000 to invest, he recommends max 3 stocks.
Agree. And what if you have a little bit more to play with?
So if you bump it up 20,000 to 200,000, he says max 5.
5.
Yep.
That's still so much lower than I thought. I feel like you always hear people talking about needing to be diversified and have way more than that.
It definitely goes against the conventional wisdom. But his argument is that when you have too many stocks, you just can't give each one the attention it needs. So you're not going to be able to react as quickly. You're not going to have that same level of understanding, and then you lose out on some of those potential gains.
And it's probably harder to keep track of everything, too. So let's say you have a really small portfolio, $3,000.
Yeah.
What does he say for that?
For $3,000, he recommends max 2 stocks. And then even if you go over $200,000, he still says to keep it relatively low, max 7 stocks.
Wow. Okay. So he's real like, focus.
Concentration is key.
So we've talked about picking your stocks, keeping that number kind of small so you really know your stuff.
Mm-hmm.
But there's also this whole thing about the timing of your buys and sells, because he talks about this thing called spreading purchases, which when I first read that, I was like, wait, what? Because the idea is you're continuing to buy a stock as the price goes up.
So basically, he's saying that in a bull market, you want to capitalize on that upward momentum. You make your initial purchase, and then if the stock goes up, you buy more in these little increments.
So you're riding the wave a little bit.
In a way, yeah, but with a really a controlled strategy. He recommends buying at 2% intervals above your initial buy point, but you stop if it goes 3% above that.
So if you bought a stock at, let's say, $50, you would buy more when it hits 51 and then again 52.
Right.
But then if it hits 51.50, you're like, okay, I'm done.
You're taking advantage of the price increase, but you're not getting greedy. You have that exit strategy in place.
I like that because it flips the whole like buy low, sell high on its head a little bit.
It's not as simple as that always.
Okay, so let's shift gears a little bit. Let's talk about short-term versus long-term investing, because I feel like that's something that everybody always wants to know.
That's the big debate.
And where does O'Neill fall on that whole spectrum?
So he actually says that the amount of time you hold a stock is really not the most important thing. He thinks that what really matters is buying and selling the right stocks at the right time. So whether that's a matter of weeks or months or even years, that's less important than just making sure you're making those smart buy and sell decisions.
So it's not about holding on for dear life, hoping it goes up.
No, not at all. He actually emphasizes the importance of cutting your losses pretty early, ideally within 6 to 7 months if something's not working out.
So you're not just letting it sit there and bleed out.
And that can be hard because sometimes you get emotionally attached. But he's like, nope, cut it loose, move on.
Okay. And I think the last big thing we wanted to talk about was all the stuff he says to avoid. He has a whole list of things that he's like, don't do this, don't do this.
Right.
What are some of those?
So he really cautions against things like day trading, buying on margin, short selling, options, all that kind of stuff.
You can really lose big. So is there anything else on that list that's surprising?
He also says to be wary of IPOs, convertible bonds,
Okay.
and even, which I thought this was interesting, income stocks with high dividend yields.
Oh, why does he say to avoid those? Because a lot of people, I think, are looking for those high dividends.
And it seems like it would be a good thing, right?
No.
But he argues that sometimes those high yields are actually a red flag.
Oh.
They can indicate that maybe there's some underlying problems with the company.
I guess the overall theme is keep it simple, do your research, be selective, and don't get too caught up in all the
Hype. Slow and steady.
awesome. All right. Well, until next time, happy investing, everyone.
Happy investing.
Yeah.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.